Welcome, everyone. Today, we're diving into the exciting world of stock investing and one crucial metric you need to know, return on equity, or ROE. So imagine this. You're considering investing in a company's stock, but how do you know if it's a good move? That's where ROE comes in. When you buy a company's stock, you're essentially buying a piece of the business, a share of ownership. Your goal as an equity investor, to see that business flourish and your share of ownership or equity grow. ROE is like a yardstick that helps you measure how well a company is doing from an equity investor's perspective. And when we're investing in stocks, we are equity investors. The magic formula for ROE is pretty simple. Net income divided by shareholders' equity. Net income is the company's profit after you subtract all expenses, and shareholders' equity is the total value of investments made by shareholders just like me and you. By analyzing a company's ROE, you can figure out if it's using your invested equity wisely. A higher ROE usually means the company is generating better returns on your investment. But hold on, as with everything, there's a catch. Companies can boost their ROE in two main ways, and this is where you need to look at it very carefully. First, they can increase their net income, which shows they're more profitable. Amazing. And second, they can actually lower their shareholders' equity. But this is where you must be cautious. Let's take a look at two companies, Lululemon and Crocs. Lulu has an ROE of 44% and Crocs has an ROE of 163%. If you were to just look at those numbers by themselves, you would say Crocs, way better investment, way better return on equity. But Lululemon has no debt and Crocs has 281% debt. You can take on more debt to reduce the equity and boost your ROE. So is that ROE at 163 of Crocs better than that 44% of Lululemon? That's for you to decide, and that's where you got to be careful. A company can lower its equity by taking on more debt, and this is called leverage. On the upswing, this can make your returns as an investor soar, but when the tide turns, it's a double-edged sword that cuts both ways. Just as leverage magnifies profits, it magnifies losses too. A company loaded with debt can sink into trouble, potentially wiping out equity in a worst-case scenario like a bankruptcy. Remember, when you're looking at a company's ROE, it's not enough to stop at the number itself. As I said, you got to dig deeper. Take a peek at how much of that ROE is coming from debt. And don't forget to compare the company's net income to its total debt. Are the current levels sustainable? ROE is your equity investor's compass. It guides you through the highs and lows of company performance. But be a savvy investor. Consider the debt factor and the sustainability of those returns. So next time you're eyeing a company's stock, you'll have a really powerful tool in your arsenal, the mighty return on equity. Happy investing, everyone.